this is not a surprise for us because the statement made by Jay Powell yesterday, warning that the rates could go higher because they are not achieving the target in terms of inflation, is clearly the signal that the Fed will not stop hiking rates. And this is clearly the signal that the equity market was waiting for, maybe to adjust the prices, to adjust, some valuation as well. So clearly there is, no worry regarding the global growth. Global growth is still resilient. Inflation is still there. Core inflation is still there. We have discussed about this, before in the UK and all over the places. And all the central banks now, they are aligned to tighten their monetary policy simply because inflation is still a problem. So in that case, this is not, a surprise for the economists and for strategists, but the market we're not expecting such, such moves and such statement coming from the chairman of the Fed, is clearly insisting on the fact that maybe they can reach the final target, the final rates. That was expressed by the FOMC last week with the dot plot. An additional 2 additional rate hikes before the year end. So clearly, this is not a good signal for the equity market, and this validates the fact that we are still very far from the target of the central banks in terms of inflation.
There seems to be a disconnect somewhat between bond markets and equity markets. When you look at the yield curve inversion in the U.S., the 2s and 10s fast approaching a 42-year record hit back in March, and yet equities have been pretty resilient. Yes, we have seen them turn down in the last 3 sessions or so, but overall, U.S. equities have been pretty strong. Is that a reflection of complacency among the equity community, or is something else at play?
Well, this is an excellent question, and this disconnection can also be seen when you look at implied volatility measures in the bond market in the US and in the equity market. When you look at the MOV index and you look at the VIX index, there is clearly a disconnection between the two metrics. But having said that, clearly, I do believe that the bond market is already pricing the recession at some point in 2024. Recession will not be something that will happen this year in the US and in all of the places, but this is a story for next year. And clearly the bond market is starting to think about this scenario of a recession, which is absolutely not the case for the equity market, for one simple reason. There is still inflation. Inflation is the best ally of the equity market. As we have inflation, we have some companies that are able to preserve their margin, and they have some pricing power in order to deliver benefit. I will not be surprised to see the earnings season will be being extremely positive for the second quarter after a very positive after a very positive first quarter of this year. So clearly there is some complacency coming from the equity market. But when you look at the data, again, earnings will be good. Inflation is still there. There is still some pricing power. There is no need for equity investors to be again in a bad mood, actually. So prices are slightly adjusting because we have this monetary policy statement, maybe a bit more brutal, maybe more rude regarding the inflation. But at some point, when you look at the fundamentals on the equity market, they are still positive. So no need to worry so far, but we cannot rule out, at some point, to see this equity volatility moving to, joining the bond market volatility, which is extremely high, still extremely high.